And now we've got a few fairly rapid-fire fireside discussions. So I'd like to welcome the first one up, which is, I think, a really nice follow-on in terms of topic, because it continues down the path of what assets are going to be tokenized first. So, Amy, Todd and Donna, it's over to you.
So, hi everyone. So we're going to continue pretty much on the discussion that you just heard. I think very interesting discussion. And there was a lot of talk about what is required for this to happen, what is required for tokenization to be the leading technology and infrastructure, let's say in 2025 and so on. So I think this is a very, this is the thing that interests this entire community. And we're going to talk about some of it as well. But first, before I start, we're going to have a very interesting discussion here with two representatives of major institutions that are coming into the tokenization, into the DLT space. I think that in the beginning of the tokenization movement, and I see a lot of faces here who've been here from the beginning, it wasn't very institutional. But now it's becoming very institutional. And I think it's very important to hear what institutions are doing, how institutions are thinking, what is the vision, and what we can expect from major institutions. So I want to start with Donna and Scott and ask each of you to describe a little bit about what you're doing in the space and what is your vision for how digitization is going to affect your bigger business and what we can expect in that space. Donna?
Great. Great. Well, thank you so much for having me, Ami and Scott. But State Street is an institution that really supports the institutional investor. So that's really important. Obviously, JP Morgan is much bigger and much more diversified, but we kind of do one thing, and that is support the institutional investor. We do that in asset servicing, in kind of the analog world, as well as have a small money manager that manages a bunch of money. So with that, we follow our clients like everybody I'm sure does. And our institutional investors are really fascinated by the technology. I'd say they've really de-emphasized crypto for the most part, except for in other small pockets of the client base. And they're looking to distributed ledger technology and smart contracts to really solve real world problems that they have today. They see real benefits in solving problems like operational efficiencies, lowering cost, all the things providing more liquidity, maybe new distribution channels. So they come to us as their service provider to help them figure out how to do that. Some of our clients are very sophisticated and want to do it themselves and have been testing and issuing tokens and coins all along, but many of them are really not. They're looking for their service provider to really provide those services to them. So that's how kind of we're approaching it, and we've been at this now for more than a handful of years, and we're focused on what our clients are focused on, which is how can you tokenize traditional assets? How do you issue digitally native tokens, and then how do you provide custody, fund accounting, and administration, which is what we do in a decentralized world. So that's kind of what we work on.
And do you provide the services mostly to your clients, or do you also work closely with other institutions on projects?
Yes. All of the above.
So I'm assuming it's not something that you're seeing just from your clients. It's an industry-wide.
Yeah, and of course, we would like new clients too. So the industry, the part of the industry that we serve, we've surveyed them. We've talked a lot to them. Obviously we communicate with our clients all the time and prospective clients, and it's very similar perspective that I just described.
I think the reason I asked the question is we sat here about a year ago, and it was the beginning of institutions coming in. And now I think what I'm hearing from everybody, and I'm seeing it from representatives of Citi and JP and others and Goldman's, pretty much the same story. This is becoming an infrastructure, a future of markets, and so on. Scott, what do you guys do right now in the space? And more broadly, what is your vision for DLT in your operation?
Thanks, Amy. So I guess almost flipping it around the other way, we talk about markets, we talk about private markets, we talk about equities, we talk about fixed income on the last panel, and I've been part of panels where had those same conversations. If they're one homogeneous market that if one thing changes, all will change, which clearly it won't. So I think when it comes back to what we're doing, I think our acceptance is that the vision of what this market will look like 10 years from now, if anyone's got that, then great. I think we're too early in the story to really think about how much of each type of asset class in what market by what type will kind of eventually evolve into using this technology, other than to say, I think a reasonable proportion of regulated markets will be on this technology, using it in a sophisticated way within a decade. And what a reasonable proportion could be, anywhere from the 10% mentioned previously to anywhere sort of sub 50. I don't think north of that is a rational number. So what's JP Morgan's kind of view of that? I think quite clearly we've got our own platform. We've had that for a few years. We've done a lot of experimentation, development in that. And we're very pleased with kind of how we can offer services to our clients on the Onyx platform. I think it's a really sort of good start point for us to learn and for our clients to learn what's possible in this space. Is it the end point? Absolutely not. And that's why we also look at other platforms like HQLX. We're sort of doing stuff across the market, particularly in the markets business, because JP Morgan's, again, not one homogeneous entity. There's lots of different businesses within that. And within the markets business, our responsibility is to be able to provide liquidity to our clients across a range of different markets. That's not going to be done on a single platform or even a small handful of platforms. Certainly not the way the structure of the market is evolving. So that means that, are we going to have a regulatory imposition of sort of everyone get on DLT? No. Do policymakers buy that? No. Are they going to agree in the short term? No. So what's really going to happen is what we're seeing at the moment is a sort of federation of experimentation across different institutions to say, like, I can offer this for my clients, I can offer that for my clients, and then eventually sort of clients are saying, well, can you guys just pair up and offer that across so we get more liquidity? We're at the beginning of that phase now. And so I think that's where we start to see interoperability, the experiment we did last year with you guys, HQLX, et cetera, like that's going to become a real thing. Partnership with broader custodians rather than their own, that's going to become a real thing. So I think that's sort of the shape of where we get to, but federated experiments that do real things with economics associated with them where we'll start, and the market will evolve from there. It's a competitive market.
So maybe instead of the whole market agreeing to do one thing like was discussed before as a central mandated thing that everybody agreed to, some interoperability solutions springing up dynamically and organically, succeeding in connecting multiple organizations, and then maybe connecting to other similar networks to create basically a network of network.
I think we've seen that. I mean, that's what we do, right? We innovate in pockets to solve problems, and that could be any kind of problem, from an expense to new revenue to liquidity distribution, et cetera. And then, you expand from there. And usually we create fragmentation, which we are doing. Then you have to find ways to connect all that fragmentation, clean up the fragmentation. I mean, every 30 years or so, we're kind of solving the same problem over and over again.
That's exactly right. I think you see these sort of individual experiments deliver, then we get a federated market across a range of different things, and then investors realize that actually digital bonds are cheaper than regular way bonds, and then they kind of go, actually, I'd like to buy more of those, less of these. How do we get? And then you start to get the inflection point where that market develops. And I think that was the qualifier that Justin put on the statement around it's either this or that, or it's a competitive market. Certainly our view is it will become sort of evolutionary through competition rather than mandated by a central body saying, let's all get on this technology.
So do you see any, the question was asked before, what do you see as the biggest hurdles for actually realizing the potential right now? What are the things that you were kind of struggling with right now that by solving them we can go faster or we can be more efficient?
Well, I think it's easy to kind of say regulatory, especially in the U.S. It's a kind of an easy answer, but it's, I think, a little deeper than that. I mean, I don't belittle the regulators ever, but they're definitely an impediment at least in the U.S. There's a definite negative bias, but that's not all there is. So I think I mentioned already fragmentation. I think makes adaptation very difficult. There's no standards. Kind of all the things that, again, every single time financial services innovates on its S-curve has the same exact problems when there's new technology that comes. So I think that, kind of lack of trust the sins of what we've just lived through over the past, 12, 18 months has also made investors skittish for sure. So I think those are some major themes.
Yeah, I think the federation of platforms is helpful to deliver specific things. It does make the challenge of getting liquidity more difficult. So interoperability solutions like FinP2P or others are important. Other models of sub-custody across different platforms could be important. The other one that's really sort of challenging is money. Like there is no cash on ledger. We have it internally on our own platform, but there is no solution to get money from one bank to another bank to another bank. So, solutions that have movement of assets on chain and cash through your fiat, that just increases our liquidity risk on our liquidity risk framework and doesn't solve a problem for us. So I think the faster we can get to a point where there is a wider selection of cash on ledger solutions that are able to be credited and debited across different banks, because that's all it is. It's someone wants to buy a bond that custodies at JP Morgan and the seller's at custody JP Morgan, the buyer custodies at State Street. We need to move the bond and then be short cash, long cash, that's it. We can do credits and debits through SWIFT, we can do credits and debits across blockchain. Let's just figure out a way that we kind of get there. I mean, the technology for that, and the technology partners I work with hate me saying this, but it is an engineering challenge. It's ones and zeros, put them in the right order, and we can solve that. The legal bit of that is quite complicated. And I think that's where, as you get past that initial risk appetite to do something and take some risk, and you've got to be in a market where people are taking real risk, otherwise it's just fun. You've got to have real risk in it, and otherwise you don't get to the bottom of the legal question. That's where I think we start to see movement. And there's enough happening in the market. There were 5 or 6 digital issuances in the period sort of leading up to the end of 2021 and the sort of preceding couple of years. There's been 20 since November 2021 to February 2023. There is an appetite and a cadence growing. There's a number of different other tokenization platforms and methodologies to get things even tokenized that are starting to emerge. So I think that there is momentum. Financial services are rubbish at R&D, because the point made previously about our investment horizon is 1 year, not 2 years. We need to get better at it. We need to accept that enough economics to wash your face is good, and then we can develop sort of multiple returns after that.
Yeah, I think what we've seen with some of the organizations is that there are two basically contradicting powers. One power is that every organization, big financial institutions, is insisting on choosing their own solution, and it has to be different from the one chosen by the other institutions, sometimes for reasons that are not great, and sometimes for reasons that are real, for differentiation and so on. But at the same time, they all want to connect with each other and work with each other. So how do you do both? And I think that one of the things that we've seen is when we analyze it, the problem was that tokenization is not just one thing. Tokenization basically is a set of things that needs to happen. You need to tokenize the asset, you need to bring the payment mechanism, and you need to basically do the settlement between them. You need to provide the destination where the client can actually buy. You need to provide the custody, maybe provide lending services. Each one of them is separate. And if every organization builds all of the stack on their own, then they can't speak to anybody else because they built the whole stack. So the solution that we found was to try to break tokenization into its component and make each component a service. So you can do a tokenization, service the industry and push your assets. And you can do custody, service the industry and be a custodian for everybody else. And everything is agnostic to the sort of technology that all the others are using. So you have those 4 or 5 components, and then they can be mixed and matched. And maybe through that way we can achieve more. And I think that's an approach that gains, it's very attractive, because on the one hand it allows each service provider to choose their own technology, but on the other hand, with a simple connection, they connect to the network and work with people that chose different technologies. So that's the model we're seeing happen. And there will be solutions like that. It's almost, what we described before, almost sound like our company was foretold. It had to come, because that's how it always works. I want to quickly, we don't have much time. I want to go into one other question that, taking advantage of the fact that you're here and an expert in custody. I think the custody in digital securities is not a very well understood concept, because it is different from custody in the pre-tokenized world. So how do you see the role of custody in the tokenized world? How is it different from the previous world? Obviously different business models and different services and so on, but how do you see it?
Well, I guess I would start with kind of the premise of custody, which is, the proper segregation of assets and safeguarding of those assets. And, I'd say that the frameworks that exist are probably still useful in a digitized world. And we need to figure out, digital custody solutions is only part of it because you still need to service the assets. Even if they're on chain, which they will be. It's inevitable. So I think that our view is that these principles still hold true, and they will hold true in a digital custody world. Now, the economics may be completely different, and kind of what does it look like to safeguard the asset may be very different. I think it makes it difficult if the asset is moving on chains, different chains, no matter what kind of integration or interoperability you create. So these are all things that still need to get worked out.
Yes, and also custody is broken almost into two. There's the custody of the management of the actual signatures and the keys and so on the one side, but on the other side, the transfer agent also has a role.
Yeah.
So
Also the underlying asset versus the fund structure.
Yeah.
So that's also, part of the consideration.
Yeah, I think we want the same from our custodians as we get today. It's confidence and security in the control of the assets. It's the ability to move those in when we need them in the market. It's the ability to get good and consistent reporting, whether it be for tax or revenue or other purposes. The output of custody, I don't think changes at all. The mechanism of how you deliver that is the thing that's changing, but that's the same as moving from bearer bonds to dematerialized securities 20 years ago. And the example that was given before around sort of Big Bang and equities being on paper and moving to electronification in the early 80s. Yes, the economic model will change, but I think all of these businesses that we're talking to and partnering with were profitable. We ran a profitable equities business pre-Big Bang. We run a profitable equities business now. They're unrecognizable in their structure, but that's just part of the evolution of the market, and that's capitalism, and that's why we have a federation of different types of things happening in the market, and then the market will concentrate on specific things that give them value, and then we'll invest in that and we'll compete. That evolution is happening. I think the bit that's difficult is, unless you have this is what could happen in the market story, it's hard to get investment and hard to get people excited about why you would do this. But as soon as you have a what could happen in the market story, it's open for such debate that actually no one really knows the answer. You need to come back to zero and start delivering on short-term, economically viable, real things and then eventually build the story from there. So that's where I think quite often in conferences like this, there's questions about what's it going to look like in 20 years. No one knows, right? There's a rational question to ask, but but you've got to have that sort of longer term view to then come back. And I think that's one of the things that certainly financial services can take, examples from pharma and technology in thinking about, as we were talking before, you could say, well, we could have waited 15 years and got this version of the iPhone or got the first one. Well, this one wouldn't have happened if we'd waited. So I think we need to sort of concentrate on short-term, deliverable, economic things. Clients the market will figure out what works.
Yeah, I think we spoke about it earlier, and I think the one difference between jumping to today's iPhone over 15 years without going through the stages, they could innovate because they live in a world that doesn't have as much regulation. But what I can say is that regulators are, and that's maybe not a nice thing to say, but regulators, if they get a lot of requests from, let's say, smaller companies and smaller players in the market, they take account. But if there's an organization that brings together 80 financial institutions to build a protocol, and then several big players such as yourselves actually go ahead and do something, and then go to the regulators and say, this is what we're doing, this is how it's done, sitting with the OCC, stage after stage, and saying, now we're doing a POC, this is what we're going to do tomorrow, and it's like big organization, JP Morgan, State Street, people of that caliber, and all talking about doing the same thing. It's a lot easier for the regulators to get comfortable with the level of change. And I do agree with you, if we don't go iteratively, stage by stage, step by step, we can't actually do a lot. If you try to design the whole monster in the beginning, it's just too complicated.
And no one will take risk if you go too far, too fast. We actually need people to take risk in these different technologies, doing different things in a way they do it that's different today. And if you don't have actual skin in the game, risk on the table, it's kind of pointless. That takes engagement with regulation, regardless of the jurisdiction, regardless of the regulator. And to be clear, like, at no point should this technology be a bar lowering exercise. We might not like all the regulation that's out there, but all of it is there for a rational reason historically that we've learned a lot sort of through different versions of financial market crises. So it's about sort of staying above that threshold and figuring out, like, how do we meet that requirement and meet that threshold using this new technology. And if there's an area where there's conflict, that's a sensible and logical conversation over the regulator and figure out whether new market structures, new technologies, new relationships can be, you know, additive to the safety of the market and to providing new services. And that's the bit that we want to sort of pivot the conversation towards.
And I wouldn't forget that, again, the institutional investor is looking for that comfort. Like, they want to be with a trusted counterparty, a trusted service provider who is highly regulated. That gives great comfort in the system. I mean, that is why, you know, we have a securities repository that is part of the market infrastructure. That's why we have trust in the system. So even though, you know, DLT is based on, you know, decentralized finance is kind of based on this, you know, other view of immutable truth that's, you know, kind of crowdsourced, that's just not the way our system works.
It's just not scalable. And I know I've tokenized my first VC fund on Ethereum, and nobody knew how to buy it, nobody knew who I was, and nobody knew how to hold a token, an Ethereum token. So it's clear that this market needs to come from the big players, and I think that especially here in this audience, people that have been working on it for several years have been a little bit, okay, why is it so slow? And I think that the point where we're here today is different from where we were a year ago. At this point, correct me if I'm wrong, you guys and your peers are coming in a big way. It's just happening at the pace that it's coming, and to make regulators comfortable with it.
Yeah, I think that's right, and I think it's accelerating, for sure.
One useful technology data point is that it was 40 years from the invention of the light bulb to the first sort of, you know, electrified streets. 40 years. It always takes longer for technology to find itself in the market than we think it is, than we think it will.
Just a subtle hint. Apart from the timer, of course, but do you want to take one question before you get off?
Of course.
Hi, Yao-Xin from Copper Plate. Thank you both. This is a question for both Donna and Scott. Thank you both for the insightful talk. Obviously, I like both of you have such a big focus on clients, and that's great to hear. I just have one question. So I'm not super interested, not super plugged into the ecosystem, but from the app, from the conversations I've had about the future, a lot of emphasis is being on the future potential of what we can achieve as a financial system. I'm not very specific about what can be actually achieved in the current system without the whole system being reinvented into the future. So I wonder if both of you could talk about, from your experience from the clients, direct interaction with the clients, within the current system, could you give us a couple of specific examples of the value add of this DLT that's currently adding value to your clients, not leveraging on what it could be potentially in the future? If you could give us the best value add, that would be great. Thank you.
Sure, well, I could start. I mean, so you can use DLT in your own four walls to really build operational efficiency. I mean, that's just, you know, it could be, I mean, we're looking at it in terms of collateral, you know, moving collateral around the system, a closed system that reduces a lot of friction points and moves collateral more quickly and optimizes it in terms of, you know, kind of an optimization engine. This is on the buy side, not the sell side. The sell side's been doing this for quite some time using existing technology, not necessarily DLT. But on the buy side, there are unique challenges there. So we see great application. There's many of them. That's just one really good example where you can have it in a closed system and already get the value of DLT and smart contracts.
So I think from our side, we launched a product December 2020. It trades every day. It's an intraday repo product. We've invested in HQLAX. They're moving collateral around sort of the European ecosystem to start with, and we'll spread out globally. We've got a payments platform that sits in JP Morgan that you can move money sort of internally within the company. We've got a tokenization platform in our security services business where you can tokenize money funds. So all of those are things that are available and in the market to differing degrees. But it goes back to the point of you've got to start with something that's got value for the client. Each of those things we have clients working with us on to develop. Each of those things will deploy into the market. Each of those things, I hope, will have competition, because through competition we'll get better services. We'll have to compete for our clients' activity, and then we'll get to a place where the market starts to develop. And competition's good because it means validation that we're in the right track. So I think there are specific things in the market now that are real that we can build off, but it's going to be a long time before they're comparable in scale to the regular market.
Okay, well, thank you very much. We better move on. I should have had you sitting over there, Amy.